Hello number-curious friends. What if I said that year-end net working capital numbers could be misleading? Yes, they indeed can, and in this video we will investigate why. By the end of this video you will know how to look at monthly net working capital, what seasonality means for businesses and how to make sense of monthly trends. But before we start, if you find our videos useful, please take a moment to hit the like button, subscribe to our channel or leave a comment. That's very important for the channel, and thank you for being with us. So, why can year-end net working capital mislead us? Imagine the situation when your business is highly seasonal and most of your activity is taking place in the middle of the year. In December, you may have very low inventories, receivables and payables, which do not represent the real net working capital profile of your business. They don't show that during the year your business may lock in a lot of cash, and you will require way more funding when compared to year-end situation. Moreover, when calculating net working capital as percentage of revenue or, for example, days sales outstanding, you will apply huge total annual revenue to low balances in December. This will produce artificially low DSOs, which may hide the problems with the collection of receivables. What are our steps to analyze monthly net working capital? We start with the simplest view, monthly net working capital trend. Plot net working capital for each month and ask, is it stable? Is it increasing or decreasing? Are there spikes? For example, if net working capital increases every month, it means more and more cash is being tied up. That might be growth, or might be a warning sign. Monthly analysis helps you spot seasonality. For example, retail companies build inventory before holidays. Receivables may increase at quarter end as sales teams may push to close quarterly sales budgets. Payables may drop when companies pay suppliers before year end, or the other way around, increase if the teams go on Christmas holidays. Seasonality is normal, but unexpected patterns are not. Let's put 2 years of monthly net working capital of our Apple business into the tables and onto the monthly stacked column chart. In the tables it will look like this, with a lot of numbers where you can spot the trends, but overall it may become overwhelming, quite a lot of numbers to look at. What we can clearly see is that we have an increase in net working capital towards the end of the year, in both years. On the chart, the trends become more pronounced. Here, we see the impact of inventory, receivables and payables on the development of net working capital in different months and how they move together. Again, it is always recommended to have a look at least 2 years of data. This way you can see whether the seasonality pattern is consistent and there were no surprises this year. Looking only at 1 year will not tell you that. Let's put monthly numbers of net working capital on the chart year over year. This way it is easier to compare consistency in the seasonality. Here we see that our net working capital profile is very consistent in both years. That means our Apple business should function with a predictable pattern. What can drive that pattern? Maybe it is revenue? Let's have a look at our monthly revenue. We see it is moving in the same direction and increases in the second half of the year. However, the profile is still different. What can be the reason? Our suppliers, farmers, start harvesting their apples in August and start delivering them to us. That's what we see as the increase in inventory. Also, our payables, the amounts we owe our farmers, increase. We can delay our payments for delivered apples until we collect money from our customers. At the same time, in August, we start selling apples to our customers. We see that our sales in August increase faster than our receivables. That means we are rather effective in managing collection of money from our customers. Situation changes significantly in September. Our sales ramp up, we keep buying apples from our farmers, accumulate more inventory, but our customers also become slower in paying us. Our receivables increase significantly, by 4 times or more. This results in our net working capital jumping to $350 in September 2024 and $320 in September 2025. In October-November, when the season slows down and sales decrease, net working capital is not increasing any longer and shows a declining trend. However, here an interesting development is taking place. In November, our inventory is growing to the highest levels during the year. What is happening? Christmas season is approaching. We expect an increase in demand and increase in sales in December. To make sure we have enough inventory, we buy more apples from our farmers and cook a lot of jam already in November, to make sure we are ready for big sales of apple jam in December. You can also see the increase in revenue in December from our monthly revenue chart. Then, in December, inventory goes down and is replaced by the increase in receivables, while we are waiting for our customers to pay. Some customers pay even later next year, and that results in the increase in receivables in January. From February until July, our business is rather slow and preparing for another spike in the second half of the year. Time to recharge batteries. So, this is an example how seasonality works when looking at our Apple business and how to make sense out of it. First, look at the expected industry seasonality. When do sales normally happen? How are they distributed during the year? Second, compare development in net working capital to the development in revenue. Does it follow the same pattern? Third, check how different components of net working capital move. For example, before the spikes in sales, often comes an increase in inventory to secure future sales. Increase in inventory may result in the increase in payables. You may need to wait until you sell your goods and get money from your customers before you can pay your suppliers. So, we have already had a look at monthly net working capital by component and revenue. But how efficient were we in managing it? Let's have a look at monthly development of DSO, DIO and DPO and compare them year over year. We start with DIO. For DIO, let's assume that our cost of goods sold is 60% of revenue and use it to calculate the days. Remember the formula? We divide inventory by monthly cost of goods sold and multiply by 30 days. For example, in August our revenue was 300. Applying 60%, we will get our COGS of $180. So our DIOs would be 150 divided by 180 times 30 equals 25. And same for other months. Now we put the DIOs on the chart. We can see that on average our DIOs in 2025 were lower than in 2024. Well done! But we see this huge spike in November. Exactly, that's where we started to accumulate our inventory of apple jam. But the sales came only in December. Makes sense, right? Let's move to DSOs. We calculate them as monthly receivables divided by monthly revenue and multiplied by 30 days. Here is how they look like on the chart. Again, an improvement in 2025 as compared to 2024. We rock in our working capital management. Here, we see the increase in DSOs in October, which we discussed before. We sell a lot in September and October, and it takes customers longer to pay. Interesting development is in January. This increase is significant, but there is a valid reason for it. We had huge sales of jam in December, and part of these receivables are still not collected in January. However, in January we have very little sales. You see, there is a bit of inconsistency. To account for such mismatches in the timing, when net working capital balances are built up and sales, there are more sophisticated methods to calculate the days. They are called count back and count forward methods, and we will discuss them in the next video. Now we move to days payables outstanding. They are calculated as payables divided by monthly cost of goods sold times 30. And that's how they look like on a monthly basis. Trends are again consistent and reflect how quick we have paid our suppliers. Here we see that in 2025, in a lot of instances we were faster than in 2024. That can be driven by faster collections from our customers when we had more money to pay our suppliers, but also by a pressure from our farmers. Let's now put all days together and have a look at cash conversion cycle on a monthly basis. We see that cash conversion cycle improved in 2025. It was faster in all months except for June. Well done! One more KPI we could look at is monthly net working capital as a percentage of revenue. It will look like this. Again, It improved in 2025 and resembles the development in cash conversion cycle. And that's your first insights into analysis of monthly net working capital. In the next video, we will look into count back and count forward methods of calculating days and why they are important in very seasonal businesses. Also, I will keep publishing accounting quizzes on the channel's Patreon. Check them out. The link is in the description. If you have any questions, post them in the comments below. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next video. See you soon and keep those debits equal to your credits.